Everyone thinks investing is only about finding good companies. It's not. It's about finding the things that everyone else is missing. The hidden consequences, the feedback loops, the second and third order effects that only become obvious after it's too late. Most investors look at a stock and ask, is this a good company? But the investors who consistently outperform, they ask a completely different question. And by the end of this video, you'll know exactly what that question is and how to use it. This is Second Order Thoughts. Let's think deeper.
Yeah, it's the ripple effect, thinking next level now. Beyond the surface, find the deeper view somehow.
Second order thinking is a concept popularised by Howard Marks, the legendary investor behind Oaktree Capital. And the idea is deceptively simple. First order thinking looks at the direct obvious consequence of an event. It's the headline reaction. It's what everyone sees. Second order thinking asks, and then what? It traces the chain of consequences beyond the obvious. It looks at what happens after the first reaction and the reaction after that. Here's the simplest way to understand it. First order thinking says, this company has great earnings, the stock should go up. Second order thinking says, this company has great earnings, but everyone already expected great earnings. The stock is priced for perfection. What happens if next quarter is merely good instead of great? Does the stock actually go down on good news? See the difference? First order thinking is about what happened. Second order thinking is about what happens because of what happened. It's about consequences of consequences. And here's what makes it so powerful for investors. In markets, the obvious conclusion is almost always already priced in. The crowd has already reacted. So if you're thinking at the same level as everyone else, you're too late. The edge comes from thinking one level deeper. Howard Marks put it perfectly. He said, first-level thinking is simplistic and superficial, and just about everyone can do it. All the first-level thinker needs is an opinion about the future. Second-level thinking is deep, complex, and convoluted. That complexity is where the opportunity lives. Here's how most people analyze a stock. They see a company with growing revenue, they check the PE ratio, maybe they read a headline or two, they watch a YouTube video with a price target and a rocket emoji, and they buy. That's first-order thinking. It's surface level. It's what everyone does. And it's exactly why most investors underperform the index. The problem isn't that first-order thinking is always wrong. Sometimes the obvious answer is the right answer. The problem is that when everyone reaches the same conclusion, the opportunity is already gone. You're buying what everyone else has already bought. You're selling what everyone else has already sold. Think about it this way. If your analysis leads you to the same conclusion as every other investor reading the same headlines, what edge do you actually have? None. You're just part of the crowd. And the crowd, by definition, gets the average return. Let me show you how this works with real examples. First order thinking says, interest rates are rising. That's bad for tech stocks. Sell everything. Second order thinking says, everyone is selling tech stocks because rates are rising. But what if the best tech companies actually have pricing power? What if they can pass higher costs on to customers? What if the panic selling has created a buying opportunity in companies with real, growing free cash flows? While everyone else is dumping their positions based on a macro headline, you might be picking up quality businesses at a discount. See the difference? First order thinking reacts to the headline. Second order thinking traces the chain of consequences. Here's another one, applied to an individual stock. First order, PayPal's stock has dropped 80% from its highs. Something must be broken. Avoid it. Second order, why did it drop? The pandemic pulled forward 5 years of digital payments growth into 18 months. Now it's mean reverting. That's not the same as the business being broken. But wait, they've replaced the entire C-suite. They're generating over $6 billion in annual free cash flow. They just struck a deal with OpenAI for AI-powered checkout, and the stock is trading at its lowest price-to-sales ratio in its entire history as a public company. Everyone looked at the stock chart, saw it falling, and assumed the worst. But the second-order thinker asks, what if the crowd is wrong? What if the falling price has actually created an asymmetric opportunity? That's the kind of analysis we do here. Now let me show you the exact framework I use. Every analysis on this channel runs through the same 3-step lens. Step 1. What does the crowd believe? Before I look at a single number, I want to know the consensus narrative. What's the market pricing in? What are the analysts saying? What's the Reddit sentiment? Because if I don't understand what's already expected, I can't identify where the gap might be. Step 2. What's actually happening under the hood? This is where the real work begins. I read the 10Ks, I dig into the quarterly filings, I look at what management is actually doing, not just what they're saying on earnings calls. I trace the competitive dynamics, I model the free cash flow, I look at the capital allocation, because the truth about a company is almost never in the headline, it's buried in the footnotes. Step 3. What's the second-order consequence? This is the question that separates surface-level analysis from genuine insight. What happens next that nobody is talking about? What's the hidden feedback loop? What's the "and then what" that changes the entire story? Sometimes the answer is, the crowd is right, and there's nothing interesting here. That's fine. But sometimes, the answer reveals that the market has completely mispriced the situation, and that's where the opportunity lives. This isn't about being contrarian for the sake of it. Contrarianism without analysis is just gambling in the opposite direction. This is about thinking one level deeper than the market, and having the work to back it up. So here's what you can expect from this channel. We take one stock, theme, article or phenomenon and peel it apart using this framework. Companies like PayPal, Shopify, Stellantis, United Health. Businesses where there's a gap between what the market thinks is happening and what's actually happening beneath the surface. We'll look at turnaround stories where everyone has given up too early. We'll examine high flyers where the second-order risks are hiding in plain sight. And we'll do earnings autopsies, breaking down what management said, what the numbers actually show, and what it means for where the stock goes next. If you're the kind of investor who wants to think deeper, not just react faster, this channel is built for you. I'm building this channel to help you see what others miss. Because in investing, the real edge isn't information. Everyone has access to the same information. The edge is in how you think about it. For deeper written analysis, check out the Substack at 2ot.co. That's the number 2, the letter O, the letter T.co. The link is in the description. Quick note, nothing on this channel is investment advice. This is education and insight to help you think better, not tell you what to buy. Always do your own research. So if that resonates with you, subscribe, hit the notification bell, and I'll see you in the first deep dive where we're going under the hood of a stock that's lost 80% of its value, and I'll show you exactly what the crowd is getting wrong about it. This is Second Order Thoughts. Let's think deeper.
Yeah, it's the ripple effect, thinking next level now. Beyond the surface, find the deeper view somehow. Ready for a chain reaction.
Join the Second Order Thoughts. Check us out on 2ot.co. Second Order Thoughts, let's go!